Good morning and welcome to the Worrells webinar, Reviving Through Restructuring Options for Insolvent Businesses. My name is Ivan Glavis and I'm one of the principals of Worrells. As the title on the slide suggests, today's presentation is all about restructuring a struggling business, or in other words, saving, rebirthing, or phoenixing a business. Given the economic climate we've endured over the past few years, it's clear that many businesses are in a tough spot, burdened with onerous and sometimes crippling levels of debt. And in such circumstances, it's understandable that business owners might be considering restructuring options that allow them to keep their businesses running while shedding some of that debt. Sometimes people are desperate and will attempt to restructure at all costs, and often these business owners will look to professionals like yourselves as their first point of contact for guidance. It's with this in mind that we thought it'd be a great time to revisit this part of insolvency law. So today, my goal is to walk you through a real-life case study of a business facing financial difficulties and explore various restructuring options that would be employed so you can see the differences between the approach. Now, there are a number of nuances in the insolvency law which interact with restructuring, and it's simply not possible or practical to address all of these matters in a one-hour presentation. For that reason, I draw your attention to the standard disclaimer slide on the screen. However, I do encourage you to think of the slide as more of an open invitation to discuss client matters. I would be happy for you to have a chat after the presentation with any one of your Worrells contacts. And of course, we can then provide you with an opinion on a particular issue and go from there. So with that in mind, this is the agenda for today's presentation. We're going to look at small business restructuring, voluntary administration leading to a deed of company arrangement, liquidation with a business or asset sale, and phoenixing pre-liquidation. Today, I'm using the term restructuring quite liberally. I don't mean it in the sense of improving an internal business process or reorganising operational strategies to achieve better performance. Instead, I'm focusing on the scenario where minor adjustments to a business are insufficient and there needs to be either a rally or a compelled to support a business's creditors, as without it, the doors simply can't stay open. In Australia, we have approximately 2.6 million actively traded businesses, with the vast majority of these classified as small businesses. Now, recent ABS data paints a sobering reality. Only 52% of new businesses manage to survive beyond the first 4 years. This survival rate tends to dip even lower for smaller businesses. For new sole traded businesses, for example, there's only a 43% chance the businesses will be around in 4 years, and only 47% for non-employed proprietary limited companies. It's interesting to think about these low survival numbers, especially for the accountants in the room. Next time you're in a meeting with a client discussing a small business, perhaps you need to consider there's a fair chance they will no longer be there within 4 years. Many factors contribute to why businesses don't survive, and obviously most business exits do not mean to end up in insolvency, as nice as that may be for an insolvency practitioner. Many owners simply lose interest, give up and move on. Others sell out. However, many are forced to do something else. In our experience, viable or not, almost every business owner believes their business is worth saving. It's like a universal truth. And based on our experiences, we estimate that 95% of failing businesses owners are just not necessarily unlucky, but they believe they are so. They believe they're better than their competitors, and there's a significant turnaround is always just around the corner. They just need a little more time. Now, occasionally that may be true, but for most of the time, it's simply not. Quite often, we are the ones who have to break the news that the business is really not fixable and the owners should consider walking away and finding a PAYG job. As you'd appreciate, that's never fun, and that's something that we would ordinarily do with you and your client. But the reality is it's not all businesses that can be saved, and business owners should take stock and consider their position before blindly embarking on a restructure just for the sake of it, or because of some emotional attachment to the business. So with that in mind, let me walk you through some suggestions for businesses that may be suitable and genuine candidates for a restructure. From our perspective, this involves ensuring the business has solid fundamentals and can be profitable without its current debts. The company's owners can or have learned from their mistakes or the issues which was caused the issues by external events have now been resolved. The company has a debt profile that supports a restructure, including considerations of personally guaranteed debts, which are not readily fixable. There is an ability to access funds from outside the entity or quickly generate funds from trading to support a restructure. There's an open relationship with any business critical suppliers, and the company's owners have the resilience to see the restructure through from start to finish. There is no doubt the process is far more taxing than it may seem at first glance, so they need to be on board. Unless you can tick these boxes, it may be that a restructuring is doomed to fail from the start. I know this may seem like a business 101 lesson, but I can't tell you how many times we've heard this same scenario. I can't also tell you how many times I've had to say, but you're not making any money now. And even if you do change something, even with the debts that don't exist anymore, you'll still be losing money. So is it really worth doing this process in the first place? So with that in mind, let's take a look at a particular scenario. Let's take it in this particular case that we have a business that's a suitable candidate and have a look at the restructuring options that are available. The easiest way I could think to do this is highlight the difference between the restructuring options and walk you through this through a case study so you can see how it applies in practice. So I picked a business model that I hope is easy to follow, even for the non-accountants in the room, and talk about a cafe business based loosely on one of our matters. You can see some of the facts up on the slide, and let me walk you through them in any case. So here we have a woman named Kelly. She's a PAYG earner in hospitality. One day, whilst browsing a business sales advert, she saw her local cafe and decided she was going to look at this particular cafe that was up for sale. Immediately excited, she thought about the prospects of actually owning this business because she'd been frequenting there for many years. Unfortunately, she didn't have many assets to her own name, but a small pool of savings, about $100,000, which was intended for a home deposit. She spoke to the current business owners, did some due diligence, or as best as she could do so without an advisor, and soon enough, a contract was signed to the purchase of the business for $250,000. To fund the purchase, her parents agreed to chip in $100,000 as a modest interest rate, and she contributed the money that she had, and the rest came from bank finance. A new company was set up, and off she went. Kelly trundles off to work, working long hours in the business, but financially it's doing okay. The first few years, the business is making a modest profit, and during this time, she also meets a partner. He starts working in the business and planning their future together, and of course, they thought the best way to get wealthy, as you do, is to replicate the business model at another location. They found another site. This time, it's not established business, but rather it's a bare-bones shop from which they wanted to start a new operation. The new site was larger, the rent was more expensive, but of course closer to town, so they thought, well, why not? We're on a winner. The new operation was set up in the same company under a 5-by-5 year lease term. A bank guarantee was provided to the landlord, and off they went. The fit-out cost more and took longer to set up than expected. Funds, of course, were required from her parents, came through in additional tranches, and of course, she had to get an extension on the bank loan. This resulted in significant sunk costs before the first dollar was even made. Eventually, she opened the new store, and turnover was ultimately slow at the start, as they always are, but losses, of course, then started to accumulate. Kelly and her partner decided to manage a store each. However, after 18 months, the new store really never took off, which impacted their ability to pay their debts. And as the financial woes set in, Kelly took a more active role in the business because she had to. This ultimately led with a falling out with a partner, and ultimately she had to fire him. And as you can imagine, that took a huge personal toll on her own business, but of course her financially. She found herself in a position looked a little bit like this. The first store was marginally profitable. The second store was unprofitable. The OTR debt is sitting around $300,000. There's a super guaranteed charge of $10,000. There's a work cover debt of $10,000. The bank is owed $125,000 and holds a security interest over the company. There's an American Express debt of $40,000 with a maxed out card. Mummy's owed $150,000 plus interest accruing at 10%. And Kelly's owed about $120,000 from the amount she's put in. Kelly's cars in the business financed to the tune of $70,000, with the car being worth a lot less than the payout courtesy of some damage. Landlord and trade creditors are largely up to date, and she's prioritising those payments moving forward. There's 8 casual and part-time staff with entitlements up to date, save for the super. In terms of assets, she has 2 businesses she can't readily sell and a plant and equipment of a modest value. So in real terms, it's a fairly bleak picture. But as you'd appreciate, Kelly doesn't want to give up, and she's invested a lot of her blood, sweat, and tears in the business. And by working closely with her accountant on things like pricing, eliminating underperforming staff, and tweaking the operating hours, there's some level of confidence that the business can, in fact, be turned around. However, the most pressing issue is this humongous ATO bill, which she needs to get her head around. The ATO recently refused the payment arrangement because she's unable to provide capacity to pay, and notably the interest on the ATO debt is running around 11%. Regardless of whether the business can be turned around, it simply can't pay that debt back. So something needs to be done. Now, I hope that humanises the situation and helps you understand Kelly's position. Now, let's look at some of the options to help Kelly survive in her business life. So let's start by looking at the different restructuring options that can be deployed to save Kelly's business, and then examine the pros and cons of each. One of the first things we do in meetings with people like Kelly is assist in distinguishing between company-only debts and those with personal guarantees. This assessment, whilst logical and simple to us as professionals, can often surprise business owners. Now, I'll walk you through this assessment the way we conducted it with Kelly. Now, even before we met, I've asked Kelly to send me copies of the 2 lease agreements and the agreements with the bank. Lo and behold, each of these contain personal guarantee clauses. I'm sure you're aware, but personal guarantees are essentially promises by Kelly to pay the debts if the company simply can't do so. This also means that exiting from the business and the underperforming stores, which he initially thought was a perfect solution, is not easily an option without some collateral damage or getting the landlord offside. It's crucial to understand that no liquidator can simply wave a magic wand to get rid of a personal guarantee. When restructures are successfully completed for a company, generally speaking, it's only the company's exposure that is compromised, while the personal guarantee survives. So this exercise of identifying where the debt sits is important for Kelly to be aware of, so she knows which debts are non-negotiable or which debts she'll need to manage separately if she wants to avoid personal insolvency. A light bulb moment here is when the realization that walking away from the second store without finding someone to take over the lease or negotiate an exit with a landlord was ultimately problematic, because she can't walk away without having some sort of personal liability due to the unpaid rent and incomplete lease term. And as you'd appreciate, it's a substantial contingent debt which is there. So there was nothing else that can be solved here in the quick term. Rather, she needed to go through a process of understanding where the debts lie. We then looked at the ATO debts. We've discussed director penalties multiple times in these type of forums, but it's important to note that directors face personal exposure for company tax debts, similar to a personal guarantee. If there's an expired director penalty notice issued by the ATO, or if lodgements with the ATO were historically done late, which means any director penalties for non-payment will ultimately not be remitted, and therefore there'll be direct exposure. Generally, a director is absolved from personal liability for BAS-related debts where the company is placed into external administration and where lodgements were done within the 3 months of their due date. For SGC debts, however, the SGC statements need to be lodged on the day they're due. So we take a look at the company's lodgement history. Fortunately for Kelly, despite not being able to pay the ATO debt, she was lodging BAS on time, and no director penalty notices were issued, not yet anyway. However, the SGC statements were not lodged in time, so the upshot was, whilst the primary ATO debt was, at this time anyway, a company-only problem, the SGC was likely had a personal liability attaching to her. Next, we look at the credit cards, in particular the American Express. Often small businesses use credit cards for business expenses, and directors may mentally consider them as a company card. However, that does not necessarily mean that they're actually company cards in the legal sense. Often they're directors' personal cards, just used for company expenses. Here's a very quick review, and of course, it was done assuming the American Express card was in fact a personal card, and that was the case. Yes, she has used it for business purposes, but the American Express is a company debt, is a personal debt attaching to her because of the relationship between her and the contract. Ultimately, has nothing to do with the business. This was the same with the car finance. That was, as often is the case, a facility guaranteed by her as the director. That means any idea of walking away from the car was problematic, and the shortfall will fall not only part of the company, but also on Kelly personally. So if we create a table and categorize the debts into two columns, Kelly's personal problems and the company's problems look a little bit like what's on the slide here. The usefulness of this is to analyze which one's where. In other words, which one do you have by way of a wiggle room for a restructure, at least conceptually in the eyes of the director, who bears the brunt of any collateral damage. So let's look at the debts for a moment. Let's have a quick look at the company-only problems. Here we have an ATO debt of $300,000, work cover debt of $10,000, loan from mum $150,000 plus interest. Kelly's contributed $120,000. Most suppliers currently up to date. There's recruiting employee debts of approximately $10,000 outstanding, making a collective amount owed by the company of $580,000. For Kelly and Kelly-only problems, it's a super guarantee charge of $10,000, bank debt of $125,000, American Express of $40,000, car finance currently up to date, landlord currently up to date, selected suppliers with guarantees currently up to date, total $175,000. Now, reflecting on this, we said that standing in Kelly's shoes and excluding the related party debts, the true amount that a restructuring is really addressing at most is $310,000. That is because the balance of the debts will follow her regardless of what happens with this business. Throughout this process, you can also work out that, as we discussed earlier, the quick wins like closing the second store or selling the car are not easy to achieve without collateral damage. Nevertheless, it's important for Kelly to appreciate the parameters she can truly work within. There is still a lot that can be gained by pulling the restructuring levers. The business could potentially be put into a cash flow positive position moving forward. Now, one option could be to consider the small business restructuring process, or an SBR as we often call them. An SBR is a fantastic tool for a struggling business. The acceptance rates are extraordinarily high, currently about 85% of the offers being accepted, which is incredible at this stage. Additionally, it can be a reasonable fee earner for accountants, of course, whose assistance is often required in the process. So it's a win-win for all sides. So what is an SBR anyway? Well, at its most basic, it's a debt restructuring tool for companies or corporate trustees. The legislation prescribes a method to put forward an offer to unsecured creditors. Basically, it's asking creditors to take a haircut with the aim of getting their distressed company back to a position of solvency. At its most basic, an SBR is really just a formal way to make an offer to creditors. Perhaps the most attractive thing for the directors is the fact that there is a limited downside in going through the SBR process, even if the offer is not ultimately accepted. And by that, I mean, if an offer is put up but happens to be rejected, for all intents and purposes, you are right back in the same spot you were earlier, and trading continues. That is, the company doesn't automatically go into liquidation, as is often the case following a rejected offer under a voluntary administration process, which we'll talk about a bit later. So we have a formal process under the Corporations Act to put forward an offer to unsecured creditors. The offer that is formulated is called a restructuring plan. That restructuring plan or proposal is sent as part of a report to creditors with voting instructions. The voting is an all on the papers process. It's simply a tick and flick form. And if more than 50% of the value of the creditors that respond say they are happy to accept the restructuring plan, then all creditors of the company are bound by it, irrespective of the way they voted. Importantly, however, especially in the case like Kelly's, it's only the votes of the non-related parties that count. Kelly and her mum cannot use their debts to push through an outcome. The restructuring plan or offer typically involves either injection of capital from a third-party source or an agreement to pay those unsecured creditors a set amount over time from future trading revenue. In terms of the type of offer we've seen, well, in this particular case, we've seen offers around 10 cents the dollar and more. They're payable to creditors over a 24-month period from future trading revenue. Other proposals we have seen include payments upfront and also over time. However, most of the proposals we've seen provide a return between 20 and 50 cents in the dollar range because it's more attractive to the ATO moving forward. And the ATO in this case is most often the largest represented creditor, full stop. Either way, we're talking about a monumental discount on debts in the range of between 50 and 90% discount across the board in unsecured creditors, of course. Now, clearly, that type of offer, what is palatable to creditors, will be dependent on the specific circumstances of the company, as well as the creditor profile. Now, I'll put these figures out there just to give you an indication of what we've seen to date. The SPR period from commencement until the end of voting is approximately 35 business days, and during that time, the company continues to operate as normal. The director is in full control of all operating functions of the company and has full control on the bank accounts. It's basically business as usual, aside from the fact that the debts that form part of the SPR are quarantined and parked to the side until a decision is made on the proposal. The role of the SPR administrator, known as a restructuring practitioner, is simply to assist the development of an offer and to report that proposal to creditors with all the required information under the legislation and all the information that once would be needed or is needed to make an informed decision. And the restructuring practitioner also deals with creditors and any questions as well as the voting. So I need to pause for a second. We don't walk into the business, and that's the most important part of the small business restructure. The business continues to operate as normal. Our role is to simply formulate the investigations and assist the director in formulating a proposal, which we then put to creditors. Now, because the SPR process is less rigorous than any other insolvency types, it's not available to all businesses. Up on the slide, you'll see the eligibility criteria. And in broad terms, we're talking about a business that is up to date with tax lodgements, or one that will be by the time the offer is proposed, one that has crystallised employee liabilities paid to date or can get there, and where the company and directors have not been through an SPR process in the recent past. The process is also only available to companies that have unsecured debts of less than $1 million. So if you have a client with a string of outstanding lodgements they can't or won't bring up to date, the SPR process is simply not for them. Likewise, clients with mountains of unpaid super will not be eligible, as you cannot compromise employee debts through an SPR process. For Kelly, however, if you remember her debt profile, provided she pays off the super of $10,000, she would meet the eligibility criteria. And assuming it's possible to show the business being fundamentally profitable, there's a prospect that she may be able to put forward an offer which would be attractive to creditors. There's no immediate impediment to an SPR being a lifesaver for business in this situation. At a practical level, under an SPR, the suggestion might be that Kelly and her mum consider forgiving their debts so that those debts are excluded. Ironically, even though related parties cannot vote, those debts still form part of the creditor pool. So unless that debt is taken off the books, it would dilute the creditor pool, making it less likely to be accepted. Assuming the business can afford it, it is entirely possible that an offer to pay, say, 20 cents on the dollar to participating creditors, payable over 2 years from cash flow, could be accepted. As discussed earlier, given the 50% voting rule, the only party that needs to be supportive in this particular case is the ATO, who will ultimately hold the deciding vote. The ATO has been very supportive of restructures to date, particularly when the company's compliance history has been good, the business fundamentals are sound, and accepting the offer is in the ATO's best interest. As I mentioned earlier, the SPR process is also only for unsecured debt. Experience tells us, particularly with upfront dialogue, that financiers like car finance and the banks are unlikely to be all that fussed about the process, but will naturally expect to be notified of the process, and of course expect to continue to be paid, or they'll call upon their security and also on the personal guarantee. Now, as savvy folks in the room will know, scrolling through the numbers, a liquidation of this company would also potentially be a bloodbath given to limited asset value. If Kelly were to simply throw in the towel and appoint a liquidator, any recoveries would go to the liquidator, and at most some loose change might spill over to the secure creditor or partially provides some employee termination costs. Unsecured creditors like the HL would simply see nothing. So commercially, a deal like this under the SBR is likely to make more sense. From a cash flow perspective, even ignoring interest, if the HL and work cover were to accept a payment plan for the debt in full over 2 years, the cash burn would be approximately $13,000 a month, a completely unaffordable amount to the company. In comparison, a 20% offer payable to an under the SBR, if accepted, could be an impost as little as $2,500 a month. So you can see and appreciate that this will make a monumental difference to the business. Not to mention that from a balance sheet perspective, a line is being drawn through some $250,000 worth of unrelated company debt. The other upside in an SBR, if accepted, is that the process is minimally invasive. The company structure itself remains unchanged. The same company name, ABN, etc., continues to be used. Additionally, the process can be completed at a relatively modest cost. An SBR will not, however, in this scenario like this, deal with the American Express debt, as it's not a company debt. It won't help close the unprofitable store given the guarantee, address the bank debt as far as car finance position and the bank debt is concerned, as both debts are secured and personally guaranteed. But if accepted, it would certainly have a significant impact on the cash burn and quite likely give the business the breathing space needed to survive. It's also important to note that the process does not guarantee an outcome. Whilst the acceptance rates are extraordinarily high at the moment, there's always that risk that Kelly might spend money on someone like me and pay the accounts to assist, and the process isn't accepted. However, that said, the risk is substantially less in this current environment. Now, another option for Kelly is to consider the voluntary administration with a view to saving a business by proposing and hopefully having accepted a deed of company arrangement. The voluntary administration process is complex and convoluted in many ways, but I try to keep it as general for the purposes of discussion and just walk through how it works in practical terms. Conceptually, I think it's useful to think about this as the big brother of the SBR process that we just ran through. It's still a process that allows a business to come out the other side with debts restructured or reduced, or a business that's consolidated, but the process is far more intensive. Certainly far more involved than is the case of an SBR process, where the directors continue to run the show and the role of someone like me is just something that just there to deal with a proposal and compromise debts. Now, as a starting point, it's useful to know that there are no eligibility criteria for entering into voluntary administration. Simply, there's no debt limit. It's irrelevant if there's superannuation owing, and the tax compliance history can be a basket case. It makes no difference. The only real requirement is the company must be or be approaching insolvency. In a voluntary administration, the directors are basically sidelined for a period of 25 to 30 business days, and during this time, the voluntary administrator takes full control of the company. They, in effect, make the decisions on trading, controlling the operations, and are responsible for all money coming in and all money going out. Importantly, at least from my position, it's that a voluntary administrator bears personal responsibility for a newly incurred trading expense. That is, if the administrator makes a call to keep trading the business and goes out and incurs expenses such as wages and supply invoices, the administrator is in effect personally guaranteeing those expenses. And as you can imagine, no administrator wants to have their personal assets at risk for one of their matters, which is why decisions on trading and incurring expenses in voluntary administration are made through a due diligence process, essentially. And for this reason, why it's important to know why it's so much more expensive than, say, a small business restructure. Now, it's also not uncommon for a voluntary administrator to get appointed, run the numbers, and make the call to close the doors almost immediately because of the cost to continue operations. The risk that Kelly runs is appointing a voluntary administrator like me, and of course, we walk in the door and realise that the cost is simply not viable, given the fact that we're running a cafe. And you'd appreciate that that's probably the case. Now, such a decision would be a captain's call for the administrator. Clearly, if the call was made, it would have flow-on consequences for Kelly personally, given the personal guarantees she provided to the landlord. The dichotomy that exists where the administrator is looking for the best outcome for the company, which may well be to rationalise the operations, whereas Kelly's mind, rightly so, is on the best outcome for her personal wealth as well, which may well be to keep both stores open. More often than not, it's to bridge the gap. If a matter like Kelly comes across our desk, we would have open dialogue before an appointment is formalised so that all parties are on the same page. That would likely include cash flow forecasts being tabled, given the comfort of trading the operations, or providing some assurances to the administrator that any trading losses may be funded externally to allow the operation to continue whilst we're dealing with any proposals. And assuming the administrator is convinced that ongoing trading is appropriate, the business is effectively then trading, but in a holding pattern, while an offer is being formulated, and Kelly and the administrators would ultimately work out what can be achieved by way of a fair and balanced proposal to all concerned. In terms of the positives, it's not uncommon for accepted offers under administrator to be much sharper, that is, potentially less than that would be under an SPR. I can tell you from personal experiences that I've seen well below 10 cents and a dollar sail through and be readily accepted by the creditors and the ATO. Now, one could envisage a scenario for Kelly where an offer is tabled along the following lines. Mum and Kelly agree to stand back from the payment of their debts under the offer. The company agrees to pay an amount equivalent to, say, all the superannuation, 10% of the work cover, and the ATO debts, payable from future trading over time. Other obligations such as lease agreements and bank finance continue to be paid as normal. Employees continue to be paid, of course, and hence no triggering of accrued entitlements or redundancy amounts. When it comes to getting a deal across the line in any administration, you need a majority in number supporting the proposition for it to succeed, or if a poll is called, by a majority in number and the majority in value. In the event of a deadlock, the administrator is provided with a casting vote. Unlike an SPR, which is a simple form for voting, the administration requires a formal meeting to decide the company's future. Typically, in a deadlock, an administrator will vote in line with their recommendations, which is likely based upon what provides the best commercial outcome. The added advantage for an administration may, in this case, have Kelly, where she's got a proposal put forward, the vote for both her and her mother. But in this case, under voluntary administration, Kelly and her mum can vote in the proposal, which in other words, her vote counts or their vote counts. As you can see up on the slide, they actually hold the majority of the debt by dollar value, which is important because if mum and Kelly vote for this proposal, then ultimately the proposal may actually get through. And if you add in the American Express debt as well, then of course there's a greater chance that the amounts will be simply sailed through, putting it nicely. So what are the voting rights? Let's explore that very quickly. The ATO, $300,000. The ATO super guarantee charge, $10,000. Work cover, $10,000. Loan from mum, including interest, $190,000. Kelly's contributed capital, $160,000, including the American Express debt. 80 employee in voting on their uncrystallised debts of $10,000. Now, in such a scenario, assuming Kelly and her mum and the employees support the proposal, it really doesn't matter what the ATO does. With the majority value and number supporting this proposal, the deed is surely to win, effectively guaranteeing a successful outcome. Now, I say effectively guaranteeing rather than guaranteeing, as any creditor can challenge the decision of a voluntary administrator to suspect or argue that there's an abusive process. You can also imagine a scenario where a related party vote is pushed through, and that's ultimately not in the best interest of anyone, which would rightly be open to challenge. I wanted to raise this scenario because, as sometimes will occur, businesses come to us committed to try small business restructuring as a solution, but they may actually be better off through a voluntary administration, particularly if they control the voting and the business fundamentals are still very strong. In the SPR scenario, you'll recall that Kelly and her mum forgave the debts because under an SPR, all debts needed to be treated equally. They either have a debt and their offer needs to be catered for to put the portion back, or they forgive the debt in this particular case. However, in administration, they simply agree to stand back and not participate under the offer, so the debt still remains on their balance sheet. This means they are given other creditors priority for the payment of the pool of funds under the offer. The accountants in room may well recognise the tax advantage of having the creditor's loans stay on the balance sheet, particularly the business comes out the other end and starts to make a profit, as those funds can, in effect, be pulled out tax-free. Now, under an SBR, that advantage is lost should the debts be forgiven. The administration process and the offer can be quite broad and quite flexible. There could be offers to close one store, pay specific creditors, change the shareholding, bring in investors, or any of a number of things. However, the trade-off is the level of practitioner involvement and therefore the cost. It's also important to note that if a proposal is a vote down in an administration, the outcome may often or not lead to a liquidation. So the position is your creditors vote no for a deal. One of the scenarios is a liquidation of that company. That's the trade-off. The offer is considered by creditors is either accepted or not, and that's the outcome that could occur. Yet another option is to restructure through a process pre-appointment, and we'll talk about that now. Kelly could, in turn, make a bid to buy back the business if the company is placed into liquidation. What does that actually mean? Well, there's nothing to stop Kelly from buying back assets of a business if the company is placed into liquidation, as she would ordinarily do, as is available to anyone else in the general population. Practically, a liquidator, if appointed, would likely walk into the trading premises and quickly determine that the business is not readily saleable. A quick discussion with a business broker might help form that opinion, but I'm sure you'd appreciate that walking into a cafe with a poor trading history is probably not easy to sell, in particular in this environment. They would justify liquidators simply saying, shut it down, let's try to sell what we can. Consequently, you should appreciate the doors would be closed and all staff would be terminated, and the liquidator would focus on selling off the remaining assets. Considering auctioneers' costs, it's plausible that the sale of assets will barely be commercially viable, with many items disclaimed or sold for minimal value, potentially fractions of a cent to the dollar. This presents a potential opportunity for Kelly, if she values the business or sees still value in the structure, to put forward an offer, despite the liquidators not seeing any real value in it. In such a case, nothing stops Kelly from waiting in the wings to pick up the pieces. She could offer to buy back the assets from the liquidator and broker a deal with the landlords to continue operations in the new entity. This strategy, whilst potentially having a large upside in terms of the debts that are shaved off, is obviously not without its risks. The outcome is simply not guaranteed. A third-party buyer may emerge, or the landlord may not be willing to deal with Kelly, or a whole host of other issues could arise. But it's undoubtedly one of the cleanest ways to rebirth a business, call it quits, and let a liquidator do their thing, and then swoop in to pick up the pieces. These type of arrangements are more common than you think, and often provide a genuine rebirth at a far lower cost than any other restructuring options. Purchasing assets from a liquidator to avoid also avoids any issues of illegal phoenixing. And if anyone has come across this term, it's an interesting one. If anyone has any issues with the sale price from the sale by liquidator, the scrutiny falls on the liquidator, not the director. Now, for Kelly, clearly such a strategy does not absolve her from her personal guarantees, and these things that she'll need to consider moving forward regardless. However, it's entirely possible that she buys back the company's asset for a few $1,000s in a clean entity and continues to run the business. She can then use the cash flow from the new entity to manage those personal guarantees. I briefly mentioned illegal phoenixing, and I wanted to explain that in more detail here. This option of buying a broken business is an option with some levels of concern and risk. It's deemed to be a good old-fashioned phoenix. It's actually very difficult to properly define phoenixing beyond the generally accepted description of a lifeless business rising from the ashes. But phoenixing encompasses a range of activities, some of which are legitimate and lawful, and some of which are illegal and abuse of the privilege that the limited liability of a company structure offers. Now, before I get into the detail, I appreciate that phoenixing can raise emotions or even push the ethical boundaries of some. Certainly, in the jury of public opinion, simply hearing the word phoenixing is enough to make people shudder. And in this presentation, I don't hide the fact that there is a vast grey area between what is an innocent phoenix transaction and a fraudulent one. Now, it would probably be no surprise to anyone that most risk-free ways of restructuring a business is by using insolvency law that exists, by which I mean there are three options we've just discussed. No advisor or director puts himself at any level of risk in breaching the law when a restructuring plan for a particular business is vetted and sanctioned by an external administrator following the formal process prescribed under the Corporations Act. Whilst most formal mechanisms exist to restructure a business, there are several reasons why business owners sometimes consider it more attractive to simply restructure a business by themselves outside of a formal appointment. Generally, this self-initiated finishing restructuring process follows these 4 steps. Number 1, a new debt-free company is incorporated, typically associated with the business owners of the existing business. The second process is the integral parts of the old debt-laden business are transferred to this new company. Number 3, the old company, which then becomes dormant and insolvent shell, let's call it, is placed into liquidation. And number 4, the new company and its business owners continue operations, having walked away from the old debt and the old scenario or old structure and running a successful debt-free business. That's the theory anyway. The reasons why pre-pack Phoenix is attractive are many, at least anecdotally, and let's go through them now. Let's start with control. The business owners consider they have more control over the business transition process and trading. They're not at the mercy of the external administrator in a formal appointment. And controlling the narrative. The business owners believe they may be able to control the narrative of the restructure a little more than would be the case in a formal appointment. This is perception that by managing all the key stakeholders in the business transition, it will mean the old company, whenever it's finally liquidated, can have a quieter exit and not everyone the company deals with will find out what has happened. Not everyone is at the mercy of the creditors, and the business owners are then not being seen at the mercy of creditors to accept a proposal to restructure. The view of the creditors become largely relevant in an informal restructure, as the owners can simply force the restructure through, as the decision makers on both sides effectively become irrelevant in the process. And the cost. Anyone that's been involved in external administration to any degree will know the external administrator's role is not straightforward, and restructuring a business formally can be costly. Sometimes the decision is one which is based upon cost alone. The business or the business owners do not have sufficient capital to see through a formal restructure, often because they're considering the issue so late that all available capital is spoken for or not existent. So as you appreciate, it's not hard to understand the temptation to go through this finishing process. And an honest business rescue with the company's directors transferring the productive assets of the old company to a new company for reasonable consideration are not necessarily doing anything wrong. When there is no intention to defraud and the creditors are paid a reasonable sum for the assets transferred, the creditors may actually be better off through a finishing transaction than if the assets were sold to a third party or the company is simply left to a liquidator to wind up. So let's cast our mind to Kelly's case. Let's say Kelly decides to incorporate a new clean company to run the cafes. She becomes the company's sole director and shareholder. She obtains a formal business valuation, of both cafes. Let's assume for a quick sale that she can get, a valuation of $40,000 net of costs and commission for one of the cafes being the profitable one, and the value, or the cafe which is not profitable, hard assets are worth $10,000. So the newly incorporated company then agrees to pay one-off figure of $50,000 for businesses, perhaps on vendor finance terms, perhaps not. A business sale is entered into, staff are moved across to a new business, the leases are assigned to the new company, suppliers are told to invoice the new company going forward, and off she goes. The old company becomes a dormant shell left with debts to the ATO, Kelly and her mum, and a few others. The old company will never be able to satisfy its debts and is no longer operational and deriving an income. In the end, a liquidator is appointed to that company. Kelly knows she still needs to keep the personal guaranteed debts alive, like the bank finance on side, but she commits to continue to pay them from the new business. You can see how this may, in fact, be a very attractive proposition for Kelly, potentially because of the lower cost option that it is. Yes, she'll need to go through the headaches of setting up new accounts, just like setting up a new business. And yes, she'll need to enjoy headaches of liquidations and the negatives. But the theory is an option, and theoretically, it's a very good option, perhaps in certain circumstances, to consider to be the better option for Kelly by way of a financial position. She doesn't have to put forward an offer. it's done and dusted. I can tell you that we often see people opting for this process because they're concerned about the narrative with suppliers and employees, and particularly around small business restructure or voluntary administration, and I guess the process that require creditors to be involved. Now, I have obviously simplified this example here, and that would be there's obviously questions that arise from making sure the sale is a proper sale and there's proper due diligence done around that, and it would need to involve the secure creditor's consent. But as you can appreciate, this is broadly a concept of how it works. Now, importantly, has Kelly done anything wrong by doing this? And if it is, what is it? Well, first of all, not necessarily. The risk is that Kelly will have the liquidator scrutinising the transaction, and a liquidator will do so because the liquidator is duty bound to do so. The question is it an uncommercial transaction? Will it be seen as being a creditor defeating transfer? And if so, there are criminal and civil penalties attaching to that. Now, company officers that fail to prevent the company from making a creditor defeating disposition, or other persons like advisors that facilitate that process, may be subject to some legal actions and certainly some serious offences with that process. Moreover, a liquidator has also the power to unwind transactions that are considered to be detrimental to the company. If she gets it wrong, the risks are certainly high. Phoenix activity has serious legal ramifications if not done correctly. Many directors and advisors have got themselves in hot water trying to go through this alone, and of course, ultimately may end up being banned as directors of companies, prosecuted, and in some instances have themselves severely reprimanded by their regulators. After all is said and done, I would suggest advisors like you in the room consider whether you do or do not feel comfortable with providing guidance on business rebirths, and also whether your professional indemnity covers you for providing financing advice. Whilst it's useful to be aware that it exists as an option, careful consideration and professional judgment are very much essential. Properly and legally executed financings are often coupled with advice from an insolvency practitioner and solicitor. So to wrap it up, we've delved into the various aspects of restructuring in a struggling business. Through Kelly's case study, we've examined the key options available, being small business restructuring, voluntary administration leading to a debt of company arrangement, and liquidation. We've also briefly touched on financing activity and more broadly, the critical criteria for small business restructure. Now, each restructuring option has its pros and cons, but the ultimate aim is to chart a sustainable path forward. Restructuring is not just about keeping a business afloat at all costs. It's about making informed strategic decisions to ensure long-term viability. A restructure undertaken without consideration for the long-term outlook is futile, potentially likely setting up people for failure. In our current environment, it's inevitable that some of you here will encounter clients with struggling businesses, and for some, they may well approach you to help find a way through. As mentioned, there are many options, and getting the right advice is key. As always, we're here to help provide that guidance. And if anyone is interested in the real-life Kelly example, once armed with the options, she actually opted to go for a small business restructure, and it was accepted. She offered about 20 cents in the dollar, and of course, it was a great outcome for her. So with that, I say thank you very much for listening to this presentation. Before I go, I just thought I might mention Equity One. Worrells are collaborating with Equity One to offer our network secure creditor investment opportunities with attractive interest returns. In recent years, the security of your capital has never been more important. As Equity One Mortgage Fund, the funds invested are directly linked to borrowers who, in return for their loan, offer a mortgage on property. Equity One are a contributory mortgage fund, which means investors directly choose the secure property upon which investments are allocated to. So if you are interested, by all means, reach out to Paul Burness, whose details are on the slide here. And with that, I say thank you very much for listening to this presentation. I hope you've got value out of it, and enjoy the balance of your day. Thank you very much.